Ordinary, everyday folks, you know, people, the citizens of Greece, they're going to be far back in line when it comes to any money package being stitched together as part of the 130 billion euro bailout. In fact, it's most likely that Greece won't actually see any of the money, much less touch it. The funds will just be shoveled back to French and German banks that hold the Greek debt. So is this really the best solution for now? Well, let's ask my guest. We have Michael Purves, Chief Market Strategist, the Head of Derivatives Research at BGC Financial. Michael, a pleasure as always. So what about this idea that you're just taking the money that would come from the European Union, you're not really giving it to the Greeks. All you're doing is telling them, look, you can make that March 20 bond payment, but that money's really going back to our banks. I mean, how does that really solve any problems on the ground?
It buys time. You know, that's sort of there's an interesting thing happening here in Europe, which is that there's the solvency issue, there's the liquidity issue, and ultimately everyone has been critical, or many people have been critical about the kicking of the can down the road, which I would argue is sort of a necessary part of the process, given how politically incoherent Europe is. So what does that mean?
Let's just define them, right? Solvency issue, this is the ability of an ongoing concern, like a country or a company, to actually continue to be ongoing and pay its debts.
Exactly. Liquidity is what you have more in Italy, where you had bond yields up at 7%, where that was starting to be a point where it was really, you know, very, very tough on the budget, actually. And I think there's an interesting thing where the solvency and the liquidity, you know, really meet in the middle quite a bit, and that's certainly, you know, part of the whole LTRO strategy was to certainly take, you know, some pressure off things like Italy, so they could indeed have, you know, at least hope to have a sustainable business model.
Long-term restructuring operation.
Right, exactly.
You think it's really going to work?
Well, I think it buys them time, but I think the problems are so structural against a backdrop of something of political incoherence that we'll be hearing about Greece not just today and Monday morning. We'll be hearing about it in several months and probably in 2 or 3 years, because if the target is 120% debt to GDP post all the restructuring, that's still twice what the IMF would say is sustainable. And you're looking at a GDP increase that's probably going to decline, you know, 4 or 5%.
Yeah, I mean, what's the likelihood that they're going to meet any of the targets anyway? Really?
Right. I mean, and the targets are not enough, right? So what that means is that there will be iterations going forwards of yet more and more restructurings.
I mean, because you keep hearing the term, right, you know, giving the medicine to the patient is... It's not that the doctor's even giving the medicine to the patient. The doctor's trying to collect the insurance money from the HMO.
Right. I mean, this is going to be echoing through for quite some time. People should just, investors should be accustomed to the fact that Greece will be in the headlines probably in a year or even 2 or 3 years, because the nature of the resolution is so incredibly complicated, because Europe, of course, doesn't have the unity that the United States does today.
All right, so what do you do with your money? I mean, what do you do if you've got money on the line here, Michael Purves?
Well, I've been bullish on the SPX to 1360. Just yesterday, I put out a note saying it's actually it's a good time to start taking profits, increase hedging, using the lower volatility levels, and I'm expecting the market to consolidate and potentially we could see something, the market have a more meaningful correction.
Why the correction?
Well, let's not forget that, we have 3 structural shifts in 3 different regions happening all at the same time. The United States is still, maybe halfway through our resolution from our crisis of 2008. The European situation, as we just discussed, is going through a massive structural shift. And then China is going through its structural shift of fixed asset to a consumer. And all 3 economies are interrelated. So if we can get 2 concurrent weaknesses at the same time, we can get the VIX, the measure of volatility, back up to 30, for more than just a day or 2, potentially over the next few weeks. Systemic collapse risk is being replaced by a new risk framework.
A trifecta of risks. All right, we're going to continue the conversation. Let's bring in our think tank. We've got Michael Purves, Chief Market Strategist and Head of Derivatives Research at BGC Financial. Also with us, Fernando Napolitano, Founder, President, and Chief Executive of the Italian Business and Investment Initiative. And John Manley, we get to blame him, Chief U.S. Equity Strategist at Wells Fargo Advantage Funds, where he helps oversee $200 billion. John, I'm going to turn to you. I really want to thank you, because we took the title of your most recent report, which is The End of the Beginning. Tell me why you chose that Winston Churchill quote.
Well, I'm starting to look more like him as I get older, but I think it's...
You got more hair.
I have more hair. It's where we are right now. I think we're not on the end strip. We still have a lot more to do, but we're working towards it. So we're beginning to work through the problems. I think we're on the shady side of the problem. It just takes a while to get everything finished up.
Detail some of the problems. I know about what's going on in Greece. We'll talk more of that in a moment. But Michael Purves was talking about take a look at the economies in Asia. Also take a look at economy here in the United States.
Look at everything.
Look at everything. Do it all.
Everything has problems. There are problems embedded in the system. We realize that, and it's priced in the market to a certain degree, but we still have to deal with it. And I think it's very important to remember that the stock market probably is going to be the disciplinarian going forward here. As the bond vigilantes worked back in the early 80s, I think the stock vigilantes work here at this point in time.
New vigilantes. Fernando, the idea that maybe investors aren't going to take the bait. They're not going to want to invest money in Italy until there's some big change in the country's economic profile. What have you seen so far in terms of investor disposition to allocate capital to Italian businesses?
Well, I think the very good news is that, at any stock exchange, you discount the future, and the future is based on today decisions that are here to last. And I think our Prime Minister in his tour in the United States,
Mario Monti, he's here in New York right now.
I was just in New York Stock Exchange with him, and I think he had a very good meetings and good reception. I think the credibility is up. The measures that are in the package, in the austerity package, but also on the growth agenda, I think are very credible. And I think he's unlocking the economy in a way that will benefit Europe. So Italy has become a potential problem. I think it's a potential solution underway.
Potential solution in Italy.
Potential solution in Italy underway. And I think the credibility of the markets that are giving, if you see the spread, it's not at the level that we wish, but it went down. And I think they're working towards that. So Italy now is part of the solution on any more problem.
Michael Purves, Italy part of the solution? I mean, can you sell that to your clients? Do they buy that?
Well, it's interesting. I think a headline hit today on Bloomberg about a major investor going long Italian stocks out of the U.S. today. And maybe it's a little bit analogous to Warren Buffett and his B of A position, last fall.
Yeah,
where
but you got a nice preferred stock position in that. He got paid to wait.
Sure, and you're buying Italy at if things work out, at extraordinarily compelling valuations. And I think, one of the things I always like to talk about when you talk about stocks, you have to talk about the backdrop of monetary debasement. And in my view, the euro is probably going to be debased as the ECB expands its balance sheet to manage the credit seizure risk. And as that happens, that's going to be favorable for equities, certainly in countries like in Italy. But again, I think, we are looking at GDP growth in countries like Italy that are really on the cusp. So the growth part is absolutely critical, and the policy has to address that.
But, Michael, if you have debasement of the euro, it's against what, right? All currencies are relative to something else. The U.S. dollar, that seems to be continuing its descent, and that's good for exports in the United States. We still manufacture and export more manufactured goods than any other country in the United States. We've got an election coming up. I mean, come on. Interest rates, the Federal Reserve Chairman says they're going to be low until 2014. How's that going to be strong for the dollar? I mean, is this a race to the bottom?
Well, this is one of the reasons why I've been a structural bull on gold and continue to be, even though the prices have appreciated, is because ultimately you can't really measure the strength of the euro or the dollar relative to each other because they're both in this race to the bottom, as you put it. You can throw the yen and the pound in there, too. They're all doing, these arguably necessary, very aggressive experiments about central bank expansion.
John, so what are you telling investors to do? I noticed in your note you've actually raised your range, your target range for the S&P 500 to 1375. So you said there's a little bit more juice left in this rally, but then watch out, maybe we're going to get quantitative easing part 3, but it's not going to be as wonderful as quantitative easing part 1 and part 2.
Well, nothing's ever as good the second or third time around, but I think it's very important to be patient at this point in time. I think investors should still be buying stocks. I think the stocks are on sale to a certain degree. Everything is fairly cheap at this point in time. The problem is, to paraphrase Mr. Churchill again, things are cheap for a reason, and we have to wait for those reasons to work out. I think we're moving in the right direction, but you have to be patient. And again, as I mentioned before, at some point in time, the stock market is the disciplinarian in here.
And what do you think is going to be the catalyst for the Federal Reserve to come in with quantitative easing part 3? You're looking at the springtime, right? April, May timeframe. You think the United States economy is perhaps going to surprise people by how sluggish it is?
Well, it's done that in the past. I think they'll do what they have to do. I think when they talk about how rates stay low to 2014, that's not really a prediction. It's not a guarantee. What it's saying is they will err on the side of the angels. If the Fed keeps rates low or they push too much money at the system, they'd rather do that than have rates go up too quickly or withhold the money the system needs.
Fernando, comment on the topic of the United States compared to Europe. How much does Europe depend on a strong economy in the U.S. to help Europe get out of its current dilemma?
Well, the relation is absolutely critical. I mean, we United States employs tens of millions of individuals in Europe and vice versa here in the United States. There is, I think, a 21% difference more people employed by European companies in the United States. So the ties are ever stronger. The stakes are enormous. And this is, I think, the reason why it is, a call for action on all the different parties to work progressively in adjusting the budget, adjusting the structural thing in Europe. I think Germany is coming along nicely.
Really? You think Germany's coming along nicely? You think they're going to write a big check?
I think whenever we talk about nations, we always expect CEO decisions. Like you make a decision as a process. We're talking about sovereign states. The complexity is enormous. It's 17 sovereign states. If you want to enlarge, it's 27. So if you take that in consideration, I think Europeans and Germany has done a tremendous job. Germany is and that's understandable, they're very stiff on making things right because they live of export and they know that 60% of their export, it's Europe. So we are on the same ship. So the debate, it's populistic in a sense, but if you talk about people that know what they're talking about, Germany's coming along nicely.
All right. Our thanks to Michael Purves, Chief Market Strategist, Head of Derivatives Research at BGC Financial, Fernando Napolitano, and John Manley. They're going to continue the conversation. Coming up, the French are getting ready to go to the polls. President Obama is getting ready to receive Chinese Vice President Xi Jinping. Will a European bailout be part of the discourse? Well, let's set out the course of events with my guests on this Taking Stock think tank. We have Fernando Napolitano. He is the founder, president, and chief executive of the Italian Business and Investment Initiative. We have John Manley, chief U.S. equity strategist at Wells Fargo Advantage Funds, where he helps oversee $200 billion. And I want to welcome to the conversation Irene Finel-Honigman, professor of international affairs at Columbia University. Irene served in former President Clinton's administration as senior advisor on finance policy at the U.S. Department of Commerce. Irene, that must have been a very big business card.
Yes,
tell me your feelings right now in terms of the supposed agreement that Lucas Papademos has said that he has approved. This is the bailout package, the $325 million cuts. That's been approved by the Prime Minister. It still has to be ratified by the Greek Parliament on Sunday. You think it's going to happen?
I think something will happen. Whether this is a solution any more than any other solution, I think that still remains very unclear. Right now, however, I'd say that both the IMF, the ECB, the EU, as well as the markets, just need some cosmetic reassurances.
Cosmetic reassurances? Why? What? I mean, do they think that their reputation has already been damaged, heaven forbid?
I think right now the Greeks are still absolutely miserable. I don't think anything has changed in the response of civil society and how this particular set of measures will be received.
You got a two-day general strike going on in Greece right now.
And I think the real problem is that, in a way, the tragedy in this whole situation long term is that we're asking Greece to do what it needs 5 years to do in less than 5 weeks.
So is that practicable? I mean, if you can identify the situation, why haven't the politicians in Europe been able to cobble together some credible plan that not only helps the economy grow in Greece, but also gives them the breathing room?
I think in many ways the plans that have been cobbled together are reasonable. And in a sense, it's almost difficult to say who the culprits are and who are the villains. I think right now, however, for the last 2 years, we've been trying to impress upon Greece in every sense what needs to be done, and very, very little has actually moved forward other than certain maneuvers which have probably had more political impact than really hardcore economic impact. Whether this will now change, I think it's quite unlikely. Whether this is, however, absolutely necessary at this point to allow the markets to come down and to move forward, Yes, definitely so.
Fernando, when you speak to people in Italy about Greece, what's been their reaction to how the Greek government and the Greek nation has responded to all of these bailout negotiations and the austerity measures?
Italians at large are concerned about Italy and themselves. I don't think they have enough room in their mind to be aware of what happens in Greece. I have to say that the major difference that I observe between Italy and Greece is that the Italian government has done a better job in communicating and explaining to the people. So the pools and the support, even though these measures are touching everybody, are not popular, people understand. So let's say if Mario Monti went to the polls right now, do you think that he would actually be elected by the Italian people? No doubt. No doubt, absolutely. The amount of anxiety and the way they're addressing it, even with tough measure, is supported by the polls. Remember that he is bearing a political cost, but not being a political party, it has no cost. So it also has to be credit to the parliament, which is putting them forward to make this change. This has not happened in Greece. I think the level of debate and communication and explanation in a former socialist country has not been to the level it deserves. And you can see in the amount of strikes that have happened in Greece and did not happen in Italy.
John Manley, has the U.S. administration communicated to the U.S. public the urgency of dealing with our own debt issues?
You know, I was thinking that as you were talking before. I don't know if we're ready to do what the Europeans are doing. To a certain degree, they're ahead of us, and we're going to have to follow at some point in time. You know, we're not exactly running a balanced budget at this point. A lot of the states aren't running balanced budgets. We're all going to have to go through this. And I think one of the things the street focuses on is this overwhelming consensus that sooner or later we're going to have to get by with less than we have right now.
Cuts to entitlement programs, for example.
We're not as rich as we think we are. And at some point in time, we either have to raise taxes or cut spending or some combination thereof.
I want to thank you all very much. My thanks to Fernando Napolitano of the Italian Business and Investment Initiative, John Manley, Wells Fargo Advantage Funds, and Irene Finel-Honigman, professor at Columbia University. This is